Hey guys, Joel Frank here, market analyst for YouTrading. And in today's video, we're going to be taking a quick look across markets, looking at what's been going on so far this week, talking about the themes that have been in play, and talking about what themes are going to be driving markets for the rest of the week. Now, uh, the standout piece of news from this week was the Bank of Japan for once. Usually it's a bit of a non-event with the Bank of Japan, but we actually had a policy change from the Bank of Japan. They tweaked their yield curve control policy. The 10-year yield on the Japanese government bond is now allowed to deviate from zero by up to 50 basis points, which basically means that 10-year yields are allowed to rise to 0.25%, which they pretty much have, up from 0.25% in wake of this announcement. And that big jump in Japanese yields has triggered inflows back into Japan as a result of the more attractive return on Japanese yields. And as people unwind those carry trades where they basically borrow in Japanese assets because of the low interest rate and then deposit that money or lend that money out in other parts of the world with higher interest rates, thus taking that interest rate differential, making that profit. Those trades being unwound as those Japanese rates rise. And that resulted in the biggest one day move in the yen, I think, in a few decades. Can't remember exactly how many, but it was definitely in a very, very long time. Dollar yen dropped 3.8% on the session from 136 to close around 131.50. Convincingly broke below its 200-day moving average in doing so. Still very much in fitting with this downtrend, and broke below this sort of short-term uptrend that had been squeezing the price action as well. Now, I did go into more detail about this pair yesterday when I pretty much said that I quite like the idea of waiting for a bit of a rally back to the 200-day moving average, back to the longer-term downtrend, adding to short positions, targeting a retest of this August low, and then targeting um, this low here from May around 126. I like the idea of this trade. I think the Bank of Japan is steadily moving in the direction of unwinding its ultra accommodative policy stance, and this is the first step. When we get the change in leadership in 2023 at the Bank of Japan, I expect those next steps, perhaps an interest rate hike, to follow. And that is definitely going to contribute to further downside in dollar yen. And I think that's going to help contribute to further downside in the Dixie. As you can see here, the Dixie remains midway through the week, very much still in this downtrend, which has been capping it and taking it lower since we fell below that 200-day moving average earlier this month, or right at the start of this month, we broke below the 200 DMA actually. The Fed still trying to be hawkish last week. Everyone remembers that. That triggered risk off in stocks and crypto. But FX markets don't seem to be buying it. The US inflation data is coming down. We are getting increased signs of weakness in the US economy from other high frequency data releases that we've been getting. And that means that the Fed pivot, it's got to come at some point. We're expecting them to take interest rates to about 5%, maybe a little bit above. But then if a harsh recession does hit in the second half of 2023, and if inflation has made really, really good progress back towards the Fed's goals, well, then maybe they can start talking, not cutting rates again, because inflation still probably won't be back at their goal, but maybe they can start talking about rate cuts so markets can start pricing them in. This is all part of that Fed pivot that we're anticipating. And for now, I'm thinking that's probably going to keep the dollar on the back foot into the year end as we can continue thinking about that theme. Although we won't get any major updates on that. We do have, just whilst we're talking about the dollar, um, let me just load up the calendar. We do have this core PCE price index data out on Friday, which is the Fed's favored gauge of inflation, which should contribute to that idea that inflation's coming under control. Other notable releases: consumer confidence data out soon, actually, on Wednesday. Weekly jobless claims, always interesting, should show that the labour market remains decent. And alongside this core PCE price index, we've also got personal spending and personal income, which is another insight into the health of the consumer's financial position in the US, which should remain okay for now, probably. But, sectors of the economy are showing signs of weakness, such as manufacturing. Um, but anyway, let's move away from FX markets now. Have a quick look at equities, which you can see dipped on Monday, but coming back a little bit as the middle of the week approaches. We had an earnings update from Nike, which triggered, in fact, let me just show you that real quick. You can see in the pre-market, it's trading at 116. The open's coming soon. And it closed at 103. So basically a big jump in Nike because of strong earnings, which is helping lift sentiment a little bit. But the technical picture here is still pretty weak for equities. The Fed's message the other week was that they're hawkish and they want to. I mean, they didn't say this, but they're basically willing to throw the US economy into a recession if that means getting inflation under control. And this is not a message which equities like at the moment. They want the Fed to send a message that they want to be more supportive of growth, which is not what we're getting at the moment. So I think rallies continue to remain vulnerable to being sold. We've got the 50 DMA coming up here, just under 3,900. We've got this area of resistance just above 3,900. That could potentially be tough to crack above into the year end. And we recently broke below this sort of short, medium term uptrend that we were in. So that's not good. That means the short term technical bias no longer remains to the upside. And we're still in this longer term downtrend that you can see. We've had multiple touches of it now throughout the year. 1, 2, 3, 4, 5, which suggests that for now, the direction potentially still to the downside. Last but not least, oil, seeing a bit of upside, had some positive weekly data out the US suggesting demand remains okay. Also, some people talking about some rhetoric from the oil minister of Saudi Arabia, saying about how their recent decision to cut output was the right decision, which some people have taken to mean that they might be willing to cut output again. We're also monitoring the impact of these price caps that have been placed on Russian oil. I mean, for me, another important thing is we've broken out of this short-term downtrend that we were in for oil, which could open the door to a rally to resistance in this 82 area. You can see that was support, turned into resistance, and you've also got the 50-day moving average. But the bleak macro picture, talking about US recession next year, China's looking pretty grim still with COVID spreading rapidly, Europe's still looking grim. Generally, things not looking good for the demand outlook at the moment means that a decisive break above this level, it will be difficult. Yeah, I think it will be difficult. So, yeah, guys, I hope you all enjoyed the video. Hope you all found it informative, and I will see you all in the next one.